Hello, my name is Jimmy Theok, and today I'm going to be talking to you about how recessions actually end. And typically, when you enter a recession, um, it's tough for everybody, your family. Just outlook is pretty dim, especially if you're not working, right? So this is the third part of sort of my economic review, and we had talked about sort of how unemployment looks like in terms of the structure in that first episode where we talked about structural, frictional, and cyclical sort of unemployment. And then the second episode we talked about how recessions typically start. And then this we'll talk about how a little bit in depth on how recessions actually end and what that looks like. We'll sort of stick at the same time period of that Great Recession period, and so there's a lot that played out, and then we'll talk about sort of what recovery looks like in different kind of shapes towards the end. Um, but I do want to sort of talk about sort of the four guiding ways of what it looks like when you go through a recession. Okay, so typically what happens on a recession, you're in it, and so the NBR, which is the National Bureau of Economic Research, will sort of announce that we're in a recession, and then they'll also announce when it's actually over. And there's typically a lag effect to some degree with regards to when they make those announcements, and so in some cases they're probably too slow to say when it starts and too slow to tell you when it's over. But typically there's a trough that's typically announced, and that's going to be sort of like where you've hit pretty much the bottom. And then you're just thinking about, all right, how long we're going to get back to go up. And so you really want to get to that bottom to come back up. And you want to look at how long that trough is going to be. In some cases, some troughs could take years. And in some cases, like we saw with COVID, you come out of them pretty quickly. And so it really depends on sort of what the economists typically would try to do, or what the Feds do, or what the White House does for sort of the economic policy response to a recession. So if the responses are too slow or not big enough, typically you'll sort of see a sort of prolonged period of time with regards to with us being in that economic contraction period. If the policies are sort of well vetted and are hitting sort of the right levers, we typically see sort of a quicker recovery. So typically you'll see sort of the trough be announced, and then you know what the peak is, and everything else that goes with it. Typically, what the MBER looks at, six indicators. Number one is real GDP, uh, real personal income, non-farm payroll employment, real personal consumption expenditures, wholesale or retail sales, and industrial production. So they look at all those sort of metrics, and they compare those year over year, month over month, good periods, bad periods, and they'll look at that and sort of analyze those numbers and make a call based off that. So some of the key dates that we had in the Great Recession, the peak was December 2007, and then the trough, which if you go back and look at it, was June 2009. Um, they call the peak at that time, the NBR called the peak at the time December 2008. Some had felt like, but that was 12 months late, right? And so a little bit a year later in regards to that call. And then they call the trough about 15 months later, September 2010. So, but we knew if you go back and look at sort of the of how that whole time period played, the actual period of time where we said with the actual peaks were 2007, and then if you go back into the math, the trough was really 2009. But the NBR at those were the time in December 2008 and September 2010 is when they were actually making those official announcements to the public. Um, and then of course there's sort of the lag effect, and we'll look at this period of time because the recovery wasn't essentially very equal. This is a period of time for those who don't know. I think, and we get into this a little bit, and I want everybody to keep in mind the asset classes that people would have actually acquired during this period of time to allow them when the recovery happened, where some folks did extremely well and some really didn't do well because they didn't have any assets. And so you saw sort of like a diverging economy and I think everybody typically says, hey, the rich got richer and everybody else sort of stayed the same or got worse. And so if you were able to hold on to assets in this period of time, when it recovered quite well for those who actually had the ability to have assets. So and we'll get into why that sort of plays out, but median household income, and of course to hold those assets, you would have had to hold on to it for quite a bit of time. Median household income didn't recover into 2020, 2016, 2015, 2016 from sort of this contraction period, from this recession. So you would have had to hold on to it for quite a bit of time. The gap between technical recovery and sort of what you felt was recovery was a pretty wide gap. One of the folks I would actually encourage the crowd to read is Christina Romer. She is a key researcher that's for the University of California, Berkeley. Did a lot of working through sort of the mythology of the Great Depression recovery. Looked at that, but also she did a really good job of doing a lot of research during this period of time as well. She did work with the Obama administration on during this period of time as well, so she has some good background on that. By the time anyone could tell you the recession had ended, the recovery had been sort of already in play, running for a year, but felt like nothing for that whole year. And so typically there's a lag effect, sort of the same way we see it when we are going into one. It's the same thing coming out of it, right? So things feel a little more optimistic because you just went through a lot of bad news, and so there's a period of like, all right, so things are like, all right, this is the new normal, but then it sort of starts to elevate. I think it goes from there. But the key point I do want to make known here is that at the end of the day, policy plays a major factor of coming out of a recession. So so a recession sort of ends in a pattern as well. So if you look at it, the first thing that happens is that you sort of capitulate. And so when you look at capitulating, what does that mean? Is that it can't get any worse, really. It's just like, all right, so this is about as bad as it's going to be. So we know we don't have a lot, people are not working, they can't buy houses, they don't have money to go buy food, barely, credits, essentially can't go get a credit card because interest rates would be like massively high. So you're at that point where there's more than your fair share of bad news. And so, and it's just tough all around. In that timeline, with regards to this period of time, and we're using obviously the Great Recession here as sort of the example because it's the last big one that we had, and is essentially you got a mixture of a lot of things going on. Housing market essentially crashed. You got a lot of banks that were going out of business, and you had the credit markets were really rough, and so between the Bush administration and the Obama administration, they were just really trying to figure out how to sort of solve this massive public problem. And so a lot of bad news at that point. So you have that first component of it being of capitulating, and then it's sort of that number two is going to be your intervention. Like what are we going to do about it? So we know we have bad news. What are we going to do to intervene on what we know is extremely bad? And so the Feds and the Treasury, which is going to be the Treasury is going to be sort of that goes with works with the cabinet and the White House, and of course you got the Feds that sort of are a little bit independent of the White House. So they come up with policy on, all right, so how do we sort of stimulate the economy for us to number one, unfreeze. We talked about freezing the markets before. How do we unfreeze the markets a little bit? How do we drive more liquidity into the market to drive some confidence back to the investor community, back to corporate firms to just get people to get hired again, to get consumers to start spending again? So they needed to sort of unfreeze. And so what are the intervention policies that need to happen to be able to get to stimulate the economy again? Uh, Number three, once you intervene, there's a pivot point where, okay, so the indicator to the market is that, hey, we know that there's an inflection point of what the White House is doing and what the Feds are doing, uh, and then that sort of signal gets put to the private markets, and somebody's got to make a move, right? Somebody's got to make a move to be able to decide, all right, we need to sort of stress test this and see if it's going to work and see what happens. And so, and then from that point on, if the stress test works, typically you'll have sort of a gradual recovery period of things getting a little bit better. You see a little bit more investments taking place, and you see the stock market start to do a little bit better. You start to see sort of asset classes start to get a little bit better with regards to the investments. And so as we get into it, one of the things you'll see is that certain asset classes during the recovery period, not all assets rise at the same time, and not all people feel the effects at the same time as well. Um, so when you look at it and you think about what were some of the things that played out in this period of time, is these are sort of the framework of sort of the pattern that typically plays out in most recessions. And so when we looked at COVID period, we'll talk about that as well too, is that so this happened in a very compressed amount of time. So and a lot of it we did control ourselves because we stopped it and we restarted it. So versus this one being more private market problems that needed to be sort of dealt with and reconciled, and it took a little bit longer to sort of reconcile all of that. Um, Moving to the point where we felt was the sort of the capitulation part was March 9th, 2009 specifically. In this period of time, the March 9th where we felt like the S&P, just to give you some key market data during this period of time, the S&P had closed at 676 points. So it was down 57% from October 2007, when at its peak of 1565. The S&P 500 typically will have a bunch of companies that it tracks. And so you see such pretty much stat gets cut in half, or more than that. And then the S&P intraday low was 666. So they called it the devil's bottom. And so stock prices just sort of crater. And so again, I think if you're able to buy stocks even at that point, you would have done tremendously well, because that would have been really the sort of the bottom of where it was. And so you can sort of see with the stock market from that period of time, if you look at it from to even today, you see sort of such a driving point straight up, straight and to the right for the most part. The Dow Jones closed at 6,547, down 54% from its peak. If you look at the Dow today, it's over 40,000 points. And so you can sort of see that. So if you were able to buy anything at that time, and there were people that were probably able to do that, you can sort of see where you would have been able to capture sort of that upside, because you're at the bottom there. At that point, when you're in it, it's hard to sort of determine whether you're really at the bottom or not, because everything is really negative, and it's such a negative environment. How do you find sort of the positivity and the calmness to be able to understand what's going on? Citigroup, which was part of a lot of this as well, was a stock that was at $1.02, down from $55 a share in 2006, but it was in 2009 it had dropped all the way down to $1.02. Bank of America is at $3.14, down from $50 in 2007. General Motors that filed for Chapter 11 3 months later. So these are things that were constantly hitting sort of the news line during that period of time. February 27, 2009, Citi gets a third bailout from the government. So when you talk about too big to fail, the government has sort of decided what entities they felt needed to actually need liquidity to stay open. And Citi was one of them. AIG was another. In March, AIG reports a Q4 2008 loss of $61.7 billion, largest in corporate history. And of course, they're going to need help. And so Timothy Geithner, who was the Treasury Secretary at that time, had introduced a number of Treasury packages to support the economy at that time. And I think that there's a lot that happened sort of under his watch, and what he had to sort of deal with on a day-to-day basis was pretty intense. I think every Treasury Secretary before and after him have not had as much TV time as Timothy Geithner had back at that time, and so he introduced a lot of different programs. One of the programs he did for sort of the public-private investment program, the PPIP, was designed to sort of help out some of these public companies and get some of the private folks involved into being able to support some of these larger companies. And so that's one program. The AARP was another one. And so in March 9th, the Wall Street Journal, which I read a lot, had sort of headlines of worst crisis since the 30s. I think everybody would have agreed with that. Warren Buffett wrote in Berkshire's 2008 annual letter, still cautious but acknowledged opportunities. Some institutional investors began at that time accumulating shares because they had felt that the news had been so bad that it couldn't get really any worse, and so some institutional investors started to be able to get into it. The thought process back then as well too was that multiple major bank CEOs probably doubted survival. John Mack of Morgan Stanley had told the staff to keep their resumes ready, and so he says, "Look, I think this is pretty brutal." And to understand why that's the case, you got to look at what the banks had to deal with. A lot of them had mortgage-backed securities, and a lot of them had it for so much of it that it would take years to sort of get rid of all of what they had, and they had to have a certain cushion of capital reserves to be able to sort of sustain their existence. And so and if you weren't making loans to anybody because you didn't have the sort of capacity to do it, but you had to carry sort of big overhead to sort of keep the staff going, you had to sort of think about where your margins were going to be. And so those are things that the government has had to take into account when they were thinking about how do we develop policy to sort of address some of that, right? So you have all these banks are carrying essentially paper that they typically could trade for profitability, but they're all worth nothing essentially because they're backed by mortgages that were not being paid. And you look at your books and you just said, hey, I got $1 trillion worth of so-called assets, but I can tell you right now they're probably worth about maybe $10 million to some degree, and you're trying to figure out how to sort of like reconcile that gap, right? And so that's a lot of the things that in that time period that the banks are going through. And I think even Ben Bernanke, who was the Fed chair at that time, had later acknowledged the system was within days of collapse. And so this moment sort of talks about sort of the capitulation point of what the market was like in that period of time. If you're sort of in an industrial distribution background like I am, in spring of 2009, you saw sort of industrial distribution orders sort of a drop down from 30 to 50% year over year. You saw a lot of capex spending get pushed back sort of indefinitely. Credit lines are being called from regional banks. Agings from customers sort of went from 30 to 90 days. And so you saw a lot of sort of everybody is holding on to cash to be able sort of to survive the period, right? So if you were giving your cash away too early, you're essentially making probably not a very wise move with regards to your ability to actually have some flexibility to actually manage the business. So if you look at the sort of the intervention and whatever it takes, the government at that time had again worked through some of the programs. One of the programs was TARP, and so we in October 3rd of 2008, there was a $700 billion, and of course the public was some were not very happy about it because the amount of taxpayer dollars going into this to save some companies. So it's a very hot political point back in that time. But nonetheless, I think the government felt like they needed to step in and do something. And so TARP was introduced in October 3rd, 2008. And again, the House initially rejected it September originally, but then it got authorized in October after sort of having multiple conversations around, hey, if this doesn't really get through, we're going to have a big problem. And so the Dow fell 778, and that's one of the first time we had seen the Dow sort of like drop that big ever at that time. Since then, we've had moments where Dow's hit 1,000. But before in that timeline, we had never seen the Dow drop that low. And so so there's a massive panic with regards to in that period of time of us being able to introduce a bill and get it passed, and then see the stock market drop because of what it did. And so we eventually in that period, I say we, but the government eventually passed this bill, and it passes the House 263 to 171, and then of course from the Senate 74 to 25. I forgot who's, I think, not familiar on which party was probably in power. I would imagine it was probably more Republican led at that time, because I think Bush was in the office still. So in that period of time, what you saw was, I think Barack was in power at that time. So and so what you saw was liquidity sort of flowed back into the market, and so and essentially it got sold to the American public, that we're going to give it back, but we're going to get the American taxpayer is going to get a profit for the dollars that we put into getting the economy back. And for the most part, that actually played out true. A lot of the companies ended up paying back with interest. And it played out through 2015, so an extended period of time. We were a lot of the companies were able to pay it back with interest. So what actually got dispersed was $425 billion, and so they didn't really use the entire $700 billion, but 425 of it got really pumped into the economy. The feds, who are sort of more independent from the White House, said that we got a plan too. And so in September 2007, what they did was the Fed fund rate was at 5.25, which is the rate that is used for banks to borrow from each other. And then they use that, when they borrow from each other, actually use that to actually pump it back into the economy in terms of like loans, credit cards, and stuff like that. So you have that with that rate. The Fed said, hey, we'll do it at zero. And at that point, you started saying, wow, zero. Okay. And so it became easier for you to go get a credit card, go get a loan, and say money's actually cheap. It's not expensive to go make an investment. And so that was sort of the first time you would sort of see that zero interest rate policy, which we've used quite a bit since then. And so typical risk with a zero when that happens is that you tend to actually see inflation is what the part you got to manage after that, right? You got to pay attention to inflation, inflationary component to it later. So at that time, that was the lowest in Fed history. And so the Fed said, hey, we're going to make it super easy for you for liquidity to flow. We're going to drop that rate to zero. And so so that made it easier for investors to say, I'm willing to take a risk. I'll take a risk if the money's cheap, right? So I'll go build out my corporate expansion because I'll never see this again. This is the best time to do it, right? So I'll never see a time where money's about at zero, and I'm willing to go spend that $20 million expansion I wanted to do and do it now versus like wait till it goes back up. So they held that, man, until December 2015. So from December 16, 2008 to December 2015, the Feds kept the interest rate from that zero range. Okay, so when we look at it, so the third phase is sort of the pivot, and you look at what some of the things that sort of played out during the pivot time, and is what exactly. All right, so we know we have a signal in the market that the Feds are going to introduce really good interest rates. Got the TARP going on. And then, of course, I didn't talk about it on the previous slide. You also had the American Recovery Act, where they said they were going to put money into the market if it's American made, and cash for clunkers. You saw that program come out as well. So there's a lot of money if you go buy American car, you essentially got reimbursed for doing that. And so you turn in a car, and you go buy a new car. And so there was some incentive driven towards those programs for stimulating the economy. And so the cash for clunkers was specifically designed to get the companies up in Detroit, GM, I know Ford didn't really take any money at that time. Chrysler and those companies needed some help, but we did design specifically a program from the administration that was called Cash for Clunkers, for those who remember that. So all of those programs led to a pivot point where policies introduced on intervention. So what is the market going to do now? Like, where's the pivot points? What do you see? And so, and if you are looking at it from an investor standpoint, what are the signs you need to see to actually make your pivot, make your change? And see, let's stress test the liquid being pumped into the economy. And so that's where, during this period of time, one of the things that came up was the supervisory capital assessment program. So that was announced in February 25, 2009, but actually released in May. It tested the 19 largest U.S. banks that was on there. And so essentially what they needed to do is that they needed to raise capital to let's look at our books. Let's figure out what were all the bad assets and what are all the good assets. Up until that time, investors were unable to price the banks. Like, I don't know what the bank is actually worth to tell the public that this bank is worth X. And so if I can't price the bank because I don't trust the information from the banks so far, because everything they've told us so far was essentially a lie. If you watch Lehman, like Bear Stearns, and I don't know what it is. And so there's a lot of unknown. So until things are actually known, you can't really make a real definitive move. And so what the banks actually had to do, they had to look at their capital needs, to say Bank of America in this case had Countrywide Mortgage on their books. And they had to say, look, I need a runway to take this big monstrosity of an asset off my books at some point, and I need to tell the public what that actually is, and how much capital I need to deal with this problem. And so before that, nobody knew what their books were. And so the stress test was essentially telling the market that I need this much capital to deal with this problem. And so 10 banks needed the capital. Bank of America came out and said, I need $33.9 billion. So if you're an investor, you're saying, hey, I can do the math backwards. I could see that they need that much capital to have that much runway to keep their lending reserves right, to be able to have the capacity to lend and everything else. And then if you back in all the policy that the White House has given them, you can sort of see a more clearer picture and understand that as bad as the news is, I now know something that's more clear than I did probably a year ago, right? So Wells Fargo came out and said 13.7 billion. GMAC said 11.5. Citigroup was at 5.5 billion. Regions Financial 2.5 billion. SunTrust at 2.2. KeyCorp Bank 1.8. Morgan Stanley 1.8. And on and on and on. A couple of banks that did pass that didn't have that bad of an asset. They had a really good runway with JP Morgan, Goldman Sachs, BB&T, Bank of New York Mellon, US Bank Corp. So all those banks did pretty good. Capital One, American Express. So they had passed sort of that stress test that the government had sort of an outline of like, all right, we need to know what you have on the books, so that we understand how to sort of develop policy for it. So and protect Main Street. And again, why this was the pivot, markets have been pricing in catastrophic outcomes, zombie banks, nationalization, but they didn't really know what was on the books. And so the test results put a number on the problem. So a knowable problem always from when you look at an asset and you price a stock, you need a knowable problem, a solvable problem. And then within 48 hours, you had Bank of America, Wells Fargo sort of announcing sort of the common stock offering. And so they said, hey, look, so now that we've said how much we have, we're going to sort of announce a stock offering. And within 6 months, most banks had sort of essentially raised all the capital privately. They didn't really use the TARP program for that because they felt that, so a lot of the they were able to sort of not have the government strings attached to it. And so they were able to raise some capital privately to actually fix their problem. So once we sort of get through a lot of that point where so money's flowing back in, the banks are starting to get and again, let me go back to that point. So they raised it privately. So there's some private money that felt confident enough to say, hey, if the Treasury, and I talk about quantitative easing, which is where the government is buying all these bonds. They're essentially saying, and just explain quantitative easing real quick, is when the feds are saying, for all the bad bonds you have on mortgage-backed securities, for all the banks that had it, some banks had it more than others, the feds said, hey, we will take all those bad bonds of mortgage-backed securities, which are trash, and we will credit your account real currency, digital currency for that. And so the feds went from a $900 million sort of like on their balance sheet of stuff they were working on to $2 trillion. And the reason they drove it up that high is because they had to sort of, again, more policy, add more liquidity to the market. And so that allowed the banks to trade a bad asset for currency, which then they use to sort of expand and have a sort of a lending. And what they ended up doing with it was sort of say, hey, we could actually lend you guys money now. Like I could go give somebody a loan, a personal loan, a business loan, expansion loan, whatever it was. And they were not handicapped or handcuffed with saying that I have $100 million of mortgage-backed securities and I don't have the capacity to actually give a loan. So the quantitative easing essentially took that away from them. It gave them the ability to actually have real assets to real currency to actually use to fund their growth as well. So between TARP was more from the White House and the quantitative easing was from the feds. Between those two things, I think banks got enough liquidity to actually help get the market back on its feet. So so some of the key people that help put all that together. If you think about that period of time, you got Timothy Geithner, Ben Bernanke, and then Bill Dudley, the New York Fed chair, through January 2009. One of the quotes typically that's pretty important is markets don't fear bad news, they fear unknown news. Stress tests killed the unknown. So we now know how bad this is, and we could actually live with that, and we could move forward. And a lot of historians credit this moment, and many economists do as well. It was sort of the turning point of everything because we actually were able to understand where the bottom was, and so and from there on it sort of took off. And so, but till then it was just like everybody was trying to figure out where the punches were coming from, and I think at that point we actually had a good understanding of how to do the math and made the change and made the investments. So um, when you look at sort of the recovery, which sort of played out in sort of number of different ways, and this is the sort of that last phase of a recovery. The S&P, remember March 9th, 2009, the low is 676. At the end of the year that year, it had bounced up to 1,115. So 65% in 9 months. So again, I think folks who were smart would have done extremely well, and sort of weathered the news. If you had the money, I think a lot of folks if you didn't have a job, you didn't have the money, so you sort of you were trying to survive. But there's people that did pretty well, saved up, and were able to sort of weather that, or still have their job, were able to sort of participate in that. The S&P 500 reached a pre-recession peak of April 2013. 3.5 years, sort of that round trip, right? So the VIX volatility peaked at 80 in November 2008. The VIX usually looks at the spikes of sort of volatility, and so it was pretty rough. I think the VIX was going up and down like crazy, and so I think it had gotten back down to 20. So you typically that sort of has a range that it goes up and down to, and so you saw the peak of that reach pretty high in November 2008. The recession itself was the longest since the Great Depression, 18 months. GDP was, if you look at sort of how the GDP played out, Q4 of 2008, you saw a negative 8.4 for GDP, which is this really bad, worst quarter. You didn't see a really good GDP number or positive one until Q3 of 2009, the first positive quarter. And then for Q1 of 2010, you saw a 3.7% bounce. So the thing I want to say is as well is that is even in that time frame, cash for clunkers from July 1st to August 24th, 2009, 3 billion programs, 690,000 vehicles had gone through it, 60% increase in fuel efficiency for trade-ins. Housing didn't bottom until 2009. Housing recovery added three more years to total recovery. Foreclosures continued to 2014. Let's go back real quick to why assets price move first. So the Feds had sort of picked an asset class to deal with. The quantitative easing essentially worked more favorable to assets that were like stocks, right? So if you think about it, stocks were a little bit more favorable. Banks, if anything tied with the banks that the banks were putting out as product at that time, was a little bit more favorable. And so if you held any kind of those asset class, you did very well. And so the market's very forward looking in price. So if you held like a house, it was a little bit more, you'd have to wait a little bit longer to see that play out because, and that really didn't play out until 2015, 2016. So you had a very big gap versus like if you had stocks, it actually just bounced a lot faster. So jobs really didn't recover really good until 4 or 5 years later. And so Wall Street technically had its recovery with a lot of these programs, and I felt the government and the Feds had sort of said that's where we need to start and need to focus. and then Main Street was sort of technically still in recession, and Main Street eventually got out of it because the main problem with Wall Street when had sort of been dealt with, and sort of that was that trickle down effect was essentially what played out. So um, and so the lag effect was interesting because in December of 2007, recession had started at 5%. By October 2009, unemployment had peaked to 10%. So 4 months after recession has officially ended, you saw a recession. You saw the unemployment rate up to 10%. So we haven't seen that in a long time. So that's double digits across the board. It's extremely high, and so I think we've been sitting at like 4% for quite a bit of time now. If you track the last several years, essentially where we've been. And so back then you're looking at a double digit number. And so it persisted. We didn't get back down to 5% until November 2015. So you saw sort of that huge lag effect with where we were. So essentially 6 years of some crazy higher unemployment and sort of all the policies sort of taking place through going through a lot of the organizations that the bank from Wall Street down to Main Street. So it just took some time to get back to everybody. The workforce during that period of time, interestingly enough, pre-recession, 66% participation rate, got down to 62%. I think a lot of folks had felt like had lost a lot of, were discouraged that they'd ever be able to work again. So disability just got really high as well. A lot of people were very discouraged from the period of time. 18 months is a long time, and some felt that they can never recover, and so some people actually retired as well too. So it's a very rough period of time. Wage growth wasn't very good either. You saw average hourly earnings year over year, 1.8 from 2011 to 2014, 2%, 2.2. So the pre-recession norms were around that 4% range. And so inflation wasn't bad either. So it wasn't like you had a lot of inflation in that period of time. And so it feels worse now because wage growth is essentially flat, but inflation is really high, a lot higher. So back then you didn't really have a lot of the inflationary period wasn't really as bad as it is today, but nonetheless wage growth was essentially just about as flat as it is today as well too. So median household income in 2007, the peak was about $63,000 in sort of real terms, and then of course in 2012 you saw sort of a dip down to 58,000. So it took about 9 years to really get back to a good point until like 2016 of when it actually officially had started, and so from 2008, and so we had felt like that period of time you really didn't get back to the same number until 2016. Globally in this time, you had sort of the Greek debt was going bad, so the European Union had to deal with that. The Irish bailout, Portuguese bailout, Spanish banking crisis, and so you saw a lot of global events play out as well, and so that was also a tough period of time there as well. And so that was a period of time where we saw not just domestically with the U.S., but you also had globally an impact there as well. Now, for the folks that were sort of in my world, you still saw a lot of and I'm talking about sort of that industrial world, is that from 2009 to 2013, we still saw orders still be completely cut in half. A lot of pricing pressures with regards to margin, cost being where it was. So from an industrial standpoint, you still saw some very limited activity. Um, but at that time, I think one of the things we did discover sort of fracking had was doing pretty good in terms of the upstream side. So we saw like oil and gas market do very well around the 2014 range. Uh, but for the most part, capex projects were still sort of deferred, and so getting credit was still pretty tight. Hiring was still pretty tight, and then aging was still pretty tight as well. And so the recession had essentially ended. It just took about 6 years for the rest of America to catch up, essentially. When you look at sort of the four shapes of recovery, it comes in different shapes. And so people will talk about, hey, there's a V shape, U shape, and you're probably thinking that if you're a casual observer, and he's like, what does that mean? Like, what does that look like? Like, what are you measuring that against? And so, and from a V, and I'll explain all four because they're important to note here because what's important to note is that it's typically how fast we can respond to the problem. Like we know there's a problem, how fast can we respond to it, and is that response effective? And then of course getting out of it. So a V shape is going to be quick. You're in and out of them, right? Very sharp, very sharp. You go in and then you're very sharply out of them. So the period of time where we had sort of that V shape was 53 in the 50s, 58, and then of course 2020 with COVID, where we were out there for 6 months, essentially from a trough to recovery. And so again, conditions to remember is that policy responds fast and big, and could create sort of that in and out. And so COVID was probably the cleanest that we've ever had in terms of getting in and getting out of it. I think we did learn a lot from the Great Recession in terms of how to actually be good at really policy making because of that. And so now, again, some policies could help you, and some could have some lasting effects, right? And so we've seen the policies from the COVID. It was good in terms of the recovery, but what ended up happening is that it drove inflation up as well too. So and so where we saw the Feds do something a little bit differently in the Great Recession with regards to how they stimulated the economy. In 2020, what we saw was so we owned closing it. So those couple mechanical components here. So we owned closing it, and we also owned opening it. And so those are all policy induced and reversible policy that we could actually play with. So that was sort of like the part that was good in that sense, right? Because you could reopen something you could close something, and go from there. Now, if it happens because of what the market does, then the policy has to be different, the approach. And so what the White House did was we added $5 trillion in fiscal stimulus, and then the Feds had $4.5 trillion in terms of expansion, kept interest rates at zero, and made it easy for everybody to sort of say that let's be able to have let's hit it really fast, and those are two things we're going to do to make sure it works. And so what you saw is a very good recovery back in late 2021, 2022, because money was cheap and everybody had saved up so much money because they weren't really using it, and plus you were getting stimulus from the government. So those are kind of things that sort of helped out. And so for U-shape, you have a little bit more prolonged bottom. And so I think some people probably call this probably should have been a W on this one because you double dip. But in the 73 or the 81, where we sort of had that period of economic contraction, we saw sort of the vocal rule where inflation had gotten so out of control that we need to actually curtail the inflation by raising interest rate to a point where it's sort of constrained organizations to sort of hire or do anything else. And so we slowed down inflation by raising interest rate high enough to to do it. The only problem is that you ended up with a very long period of time um, with being in a recession. So deep recessions with significant structural components um, is going to create sort of that U shape where it takes a little bit more time. That bottom is going to be a little bit longer than typical to come back up. The L shape is going to be sort of really rough, right? So it's going to be like your bottom's going to be sort of extremely extended, and and in some case we typically look at, in this case we're looking at the Great Depression, where you saw about a little bit of I saw about 12 years in all of how that, in terms of actual true recovery. And we're talking about pure recovery, because if you're not going into recession, they may essentially say it was over, but there's still sort of a recovery period of like, all right, how long does the recovery period take? And so in this case, the Great Depression was about 12 years, and so you have that long lost, call it the lost decade of the market, right? So, and then when you look at sort of like the K-shaped recovery, which is very new shape for us, is when asset price recovered fast and wages didn't recover for years. And so most modern recessions, and I would say going forward, are going to look like this. And so you're going to have an asset class that sort of takes over and say are going to do extremely well than others. And so asset holders had, if you look at the 2020s, asset holders had since COVID had biggest years ever since 2021. Lower income workers struggled. It's like if you didn't have the ability to have that, your recovery was essentially on a different timeline. So we call that sort of the diverging recovery. You eventually recovered, but you were going to take a little bit longer to recover because you held a different asset that was essentially like if you're lucky enough to have assets such as houses and stocks and everything else, and bonds, whatever assets you've accumulated, you essentially sort of saw the recovery. You see the recovery sooner versus someone that doesn't. So. And in that economy, you sort of diverge, right? So you get that K shape look to it, and so and typically, and you got to look at how the Feds actually play this out, because more of their policies are going to play towards the assets of the stocks and bonds and everything else to recover a little bit sooner than mainly the stocks to cover faster than anything else, and so. Because that has proven to work in the past and certainly would work going forward. And so, but it creates a diverging recovery component to the economy. So something worth noting, but it's certainly worth talking about too. It's a critical point of where we are in a society, and so not everybody gets to feel it going down. And you can make an argument too, even in those VU and L, there's a component of folks even in those that have probably quicker recovery than the rest of the public. But the first time we've actually sort of seen it more mass scale is sort of that more modern economy where there's so much more participation with it, with regards to how we do our 401k plans, the access to different kind of vehicles of money. It's much more different now than it was back in the day, and so there's a much more participation across the American public on where they're at. But there's still some divergent component to America where they don't have access to that because of where they're at, right? So. Where we are, the pattern is always the same. Again, to reiterate the points, you capitulate, intervene, pivot, recover, and then that gets to Wall Street, right? So that's sort of where that is in that sense. And so, what comes next? The recovery will look more like 2009 than 2020. So I do think that uh, as we go through more recessions in the future, the recession we saw in 2020, in my opinion, is more government induced, sort of a black swan moment. I do think naturally the markets will typically dictate how we go into that we go into recessions, and then we got to come out of them. And I do think that it's going to be more of uh, of of how it's going to be more realistic to what we saw to the Great Recession in previous recessions. Either we have an inflation problem that we raise interest rates too high to actually stop or limit economic activity, or we talked about structural unemployment last time, and so what does that do? Does that create a recession where we start to slow down? If there's not enough economic activity, what do we do to sort of have policy to change a lot of that? So you'll see a lot of that in the next couple of years. Uh, so my call here is that slower, more uneven, and felt by ordinary people for longer than markets suggest is what I think, and I'll in the future videos I'll sort of talk about that a little bit more of why I feel that way. But for the most part, I do think that uh, slower, more uneven is going to be where it goes. Because we saw that same component to it in the Great Recession. I do think that we will see a little bit similar effects to it um, going forward, mainly for the point of we don't know where we go with AI and what that does with the market, and I don't know if there's policy yet that we've thought about today that's going to help us understand how to actually fight that. So, uh, and I do think there's got to be a tremendous amount of policy to make sure that that we don't leave behind sort of a decade or 2 decades of a generation of workers in the workforce. So um, so this presentation was more about, hey, in closing, this presentation was more about like, hey, here's how a recession actually ends, and here's the components of it. And so I hope that it allowed you guys to think through some of the scenarios of what we talked about, and if you have any opinions, thoughts, disagreements of what I probably had on here, and sort of and talk through it. But it's certainly an interesting period of time where we saw a lot happen in the U.S. in that timeline. So again, thank you for the time.